Good afternoon. It's Monday, January 29th, 2024. I'm Jared Hall with Harvest Investment Strategies. Welcome to the week ahead, our weekly video update for clients and people in our network, where we detail events that may impact financial markets each week. Before touching on the events of this week, let's unpack last week's action. The S&P 500 index rose for the third consecutive week last week, as the first reading of fourth quarter economic growth came in stronger than expected and some earnings topped estimates. The preliminary readout for fourth quarter GDP growth rose at an annualized rate of 3.3% in Q4, according to an advanced estimate by the Bureau of Economic Analysis. The consensus was for a 2% gain in a survey compiled by Bloomberg, which obviously GDP outperformed that estimate. In the third quarter, real GDP grew at 4.9%, which was a revised estimate. While the growth was expected to slow down in the first quarter of 2024, thus far, the economy has held off from recession, and estimates have continued to come in stronger than expected. On the inflation watch, late last week, the December PCE personal consumption numbers were released, showing prices increased in December 0.2% over November. On an annualized basis, prices were up 2.9% in December. This was good news in regards to inflation, as it's getting more near the Federal Reserve's 2% target. By the end of last week, roughly 16% of the companies that make up the S&P 500 had announced their earnings about the fourth quarter. At the moment, the earnings growth rate is negative for all the companies that have released, which is aligned with what our expectations were, and that the fourth quarter would be the slowest quarter for the year 2023, as the real implications of higher rates has taken its time to show itself in the economy. Looking ahead to this week, we'll have another 25% of the constituents of the S&P release their earnings, in addition to the first Federal Reserve meeting of 2024. The expectations for the Fed are for them to pause and hold rates steady in January. However, more importantly, the Fed will be watching we will be watching for cues from Chairman Powell in his prepared remarks and the Q&A session after the release. He will begin to slowly change his rhetoric from noting that the board's primary concern is beating inflation down until the job is done, towards hinting that the board is concerned with loosening the restrictive stance before major shocks rear their ugly head in the economy. This process is fragile, and most likely he'll play the game of deflecting away from direct questions and restating his prepared remarks. Each word will be dissected to figure out what the Fed will do next. The indicator we keep track of for this is the CME's Fed Watch tool, which shows that the expected 6 rate cuts for the year 2024 is slowly drifting downward towards 5. It also notes a 46% likelihood for a cut in March and a 51% likelihood in May's meetings. This week may be choppy in the markets with all the news for the market to digest, and we expect that if anything, some sector rotation in terms of performance may take place. So this would be healthy price action for the market, as it gives current leaders a pause and gives future leaders a chance to show who they might be and guide the future direction of the market. That's all for this week. Thanks for watching.